Welcome back to Tax Intel. Today we're talking about one decision that could literally be the difference between your kids paying $0 in tax on your home or writing a six-figure check to the IRS after you're gone. If you own a home and you're planning to just put it in the kids' names while you're still alive because it feels kind, this video is for you. Most parents think, I'll give them the house now so it's simple later. But depending on how you do it, you could accidentally turn your family home into a huge tax bill for your children. In this video, I'll walk you through why giving the house early can backfire, how one little tax rule can wipe out a massive capital gain, and what smart families are doing instead to keep more money in the family and less in the government's pocket. Stay with me, because by the end of this video, you'll know exactly which option is more tax efficient for your family, and the one mistake you absolutely want to avoid when passing your home down to your kids. The homeowner's dilemma: give now or let them inherit later. Let's start with the situation a lot of homeowners are in. You've worked your whole life, you've paid the mortgage for roughly 30 years, and now your home is probably the biggest asset you own. You're getting closer to retirement, and you start asking yourself, what happens to this house when I'm gone? How do I make this easy for my kids? Most parents land on two options. One, give the house to the kids now while you're alive. Put their names on the deed, maybe even take yourself off. Two, let them inherit it after you die, through your will or your trust. On the surface, option one sounds really kind. You get to see your kids own the house while you're still here. Maybe they move in, maybe they rent it out, and you feel like you've checked a big box on your take care of my family list. A lot of people also think, if I transfer it now, there's nothing to deal with later. No lawyer, no court, no drama. That's the instinct. It feels simple and generous. But here's the part almost nobody explains at the kitchen table. Those two options, give now versus inherit later, can lead to completely different tax results. Let me give you a simple example. Imagine Linda, a widowed mom in her late 60s. She bought her home in a small town for $180,000 years ago. Today, because the housing market went crazy, that same home is worth about $650,000. She has one daughter, Emily, and Linda's goal is simple. When I'm gone, I want Emily to have this house. I don't want the government to get a huge chunk of what I've worked for. So Linda does what a lot of parents do. She hears from a neighbor, just add your daughter to the deed, that way it's already in her name. No lawyers, no tax pros, just friendly neighborhood advice. From Linda's perspective, she's being smart and loving. From the tax perspective, she might have just handed Emily a giant future tax bill. Because when you transfer property while you're alive, your child usually takes over your original number, what you paid, as their starting point for tax purposes. That means if Emily later decides, I don't want to live in this house, I'd rather sell it and use the money to buy a different home closer to my job, she's not just selling her mom's house. She's selling a property with decades of built-in gain attached to her mom's old purchase price. Fast forward a few years, Emily sells the house for around $650,000. On paper, the IRS doesn't see a nice family home that changed hands. They see something like, hey, this house was originally bought for roughly $180,000. Now it's sold for around $650,000. That's about $470,000 of gain. And we want our share. In other words, Linda's kind gesture, I'll give it to you now so it's simple, may have turned into a very expensive mistake. Now compare that to a different path. Same family, same house, same love between Linda and Emily. But instead of putting Emily on the deed today, Linda keeps the home in her name and makes sure the house passes to Emily through her will or her trust after Linda's death. From a tax perspective, that's a completely different story. In that second scenario, When Emily inherits the home, the tax law basically hits a reset button on that old purchase price. Instead of carrying Linda's old number from 30 years ago, Emily's starting point gets adjusted to what the home is worth around the time she inherits it. And when that reset button gets pressed, the potential tax bill attached to decades of appreciation can shrink dramatically, sometimes down to zero if Emily sells soon after. We're going to break down exactly why that happens in the next section, and I'll show you how this reset button works with real numbers. But for now, here's the big takeaway from this first part. The emotional decision. I want my kids to have the house now. And the tax-smart decision are not always the same decision. And the timing of when you pass the home, before or after death, can decide whether your kids keep most of your hard-earned equity or hand a big slice of it over to the IRS. So if you're a homeowner and you've ever thought about just signing the house over to your children, you need to understand the rule that changes everything. That rule is called step up in basis, and that's what we're going to unpack next. But before we do that, hit the like and subscribe button if you are enjoying this video. How step up in basis really works and how smart families use it. All right, now let's talk about the rule that quietly decides whether your kids pay a huge tax bill or almost nothing when they sell your home. Step up in basis. First, one simple idea: basis. Your basis is basically what the IRS thinks you paid for the property. If you bought your home for $250,000, your basis starts at about $250,000. When you sell, the IRS does not tax the full sale price. They tax the gain. Sale price minus basis equals capital gain. So if you sell that home later for $750,000, your capital gain is sale price, $750,000, basis, $250,000, capital gain, $500,000. That $500,000 is what can be hit with capital gains tax. Now let's add your kids to the story. Gift while you are alive versus inheritance after death. Meet Robert and his son, Daniel. Years ago, Robert bought a small home for $220,000. Today it is worth about $900,000. Robert wants Daniel to have the house, and he sees two paths: give it to him now while he is alive, or let Daniel inherit it after Robert's death. Scenario A: gift while Robert is alive. Robert signs the deed and gifts the home to Daniel. Emotionally, this feels great, but for taxes, Daniel steps into Robert's old shoes. His basis is now $220,000, the same as his dad's. A bit later, Daniel sells the house for around $900,000. For the IRS, the math looks like this: sale price, $900,000. Basis, $220,000. Capital gain, $680,000. If you apply a combined federal and state rate around 20 to 25%, that $680,000 gain can easily turn into well over $130,000 of tax. Robert wanted to help his son, but by transferring the home too early, he may have turned decades of appreciation into a very expensive tax bill. Scenario B: inheritance with step up in basis now. Imagine Robert keeps the house in his name. His will or trust simply says, "When I die, this house goes to my son, Daniel." Robert passes away when the home is still worth about $900,000. Here is where step up in basis kicks in. When Daniel inherits the home, his basis gets reset to its market value at the date of death. So instead of using Robert's old $220,000 number, Daniel's basis becomes $900,000. If he sells the home soon after for about $900,000, the math is sale price, $900,000. Basis after step up, $900,000. Capital gain, $0. No gain, no capital gains tax. Same family, same house, same value. but a totally different tax outcome just because of when the transfer happened. That is the power of step-up in basis. Does step-up in basis apply to rental properties? A question we get all the time at Tax Intel. Does this also work for my rental properties? In many cases, yes. If you own a duplex, a small apartment building, or a single-family rental that has gone up a lot in value, your heirs can also benefit from a step-up in basis when they inherit those properties. Rental real estate is more complex because of depreciation and other adjustments, but the core idea is the same. Transfer it the wrong way at the wrong time, and your heirs may face massive taxable gains. Let them inherit, and a step-up in basis can wipe out a lot of that built-in gain when they sell. This is why wealthy families do not wing it. They use the rules that already exist to legally minimize tax, and step-up in basis is one of the strongest tools they have. Smart estate planning moves. So what do you do with all of this if you are a typical homeowner? For many middle-class and upper-middle-class families, a smart starting point looks like this. Keep the home in your name while you are alive. Make sure your kids inherit it after your death. Put that plan inside some basic estate planning. 3 simple steps. Step 1. Get a will or irrevocable living trust in place. Spell out who gets the house. A trust can also help your family avoid probate, that slow court process after death. Step 2. Talk with a tax professional or estate planning attorney. They can look at your full picture, kids, rentals, business, investments, and confirm if waiting for step-up in basis makes sense for you. Step 3. If you want to help your kids now, consider using cash or other assets without huge built-in gains. Instead of rushing to hand over the house, you keep control while you are alive. Your kids get clear instructions after you are gone, and the tax code works for your family instead of against it. Used wisely, step-up in basis is one of the quiet ways ordinary families can build generational wealth in America. And you do not need to be a millionaire to use it. So here's the bottom line. If you own a home and you want your kids to benefit from it, how and when you transfer that home matters just as much as who you leave it to. Gifting the house while you're alive can feel generous, but it often locks in your old purchase price and saddles your kids with a huge taxable gain when they sell. Letting them inherit the home instead can trigger a step-up in basis, so decades of appreciation can pass to the next generation with little or even no capital gains tax when they sell. Add a basic will or trust. Talk with a tax pro, and you can turn your family home into a smart tax move, not an accidental tax trap. If you found this helpful and you want more clear breakdowns like this, don't forget to like the video, subscribe to Tax Intel, and turn on notifications so you don't miss the next one. I'm curious, what's the #1 question you still have about passing wealth to your kids? Is it about homes, rentals, or something else? Drop your question in the comments, and we might cover it in a future video.